Hi, friends. Let's continue from where we left off. So, we're going to be looking at um, property, plant, and equipment transfer between parent and subsidiary. If there's a profit element, what do we do? Okay. And when we have transferred the asset to the subsidiary or to the parent, to the member of the group at a profit, remember it means it's going to increase there will be an excess depreciation charge. Okay. And we need to reverse all those transactions. So, very easy, one step at a time. We'll look at it and then you'll be fine. Okay. So we move on with where we left off. Okay. From where we left off. So if you take a good look, okay, the theory first. The theory first. Now at the reporting date, let me be sure we've not jumped any. Okay. So at the reporting date, if the group has transferred any non-current asset from one member to the other, okay, a fixed asset, a property, plant, and equipment, any profit that we have identified within the transfer must be removed. Okay, must be removed to reflect the real carrying amount of the asset as a cost to the group. Okay, so if I transfer an asset of 10,000 to you, if the original cost is 15, we must actually recognize the 15, not the. If the original cost is, let's say, 15 and I transferred it to you at 20,000, okay, let me put it that way. We are supposed to recognize the 15, not the 20 extra that we've given to you. Okay. So there is always an unrealized profit in the case of transferring property, plant, and equipment between the groups. Okay. So we have to adjust this unrealized profit by reducing the carrying amount and also adjusting for the retained earnings. So two things we need to look at over here. Two adjustments normally that we need to look out for when preparing or when posting provisions for unrealized profit on non-current assets. First, the one who is selling has recognized profit on it. I sold it to you for 20 when it's actually 15. Okay. The extra 5,000 must be taken out from the seller's retained earnings, whether the parent or the subsidiary, it must be taken out. Okay. And then the purchaser who has purchased the asset at the higher cost, you would have seen that this person would then we now have to increase his retained earnings by the excess of the depreciation. I bought it for 20,000 when in actual cost the cost to the parent or to the subsidiary or to the member of the group who sold it to me is 15. So what has happened is that I have charged excess depreciation. If they had given it to me at 15,000, I would have charged my depreciation charge, maybe 10% straight line on the 15,000. Okay. But they gave it to me at 20,000. So ordinarily, I would keep it at 20,000 and charge what? My depreciation charge on the 20. So what is happening is that I've increased my depreciation. If you increase depreciation, what happens? You have increased your expenses. If you increase your expenses, what happens? You have reduced your profits. Okay, so in order for my profit to reflect the reality, I need to add back the excess depreciation that I have charged. I hope this makes sense. Okay, so the seller who had recognized profits on the asset that he's transferred to the member of the group, first this person has recognized a fake profit in the family in the same group. So go into his retained earnings or his profits reserves and subtract that amount. Okay, now, the one who has bought the asset has ended up charging higher depreciation because it was sold to him or her at a higher price. Once he has charged excess um, depreciation, what is happening is that excess depreciation will increase his expenses. If it increases his expenses, his profit will drop. Therefore, let us go back and reinstate the excess depreciation that this guy has charged himself. Okay, that's all we are talking about. Okay, now let's take an example. So, Panya owned 70% of the shares of SADA on January 2016. Panya sold an item of plant. Its fair value is 70, and the current amount in the books is 50. Parent sold to subsidiary and recognized excess. Excess of what? Excess of 20K. Okay. Its remaining useful life was 5 years. 5 years. Okay. So ideally, it should have been 50. but he sold it for 70. Okay, so what will happen? Assuming there was no transfer, how would we charge depreciation on this? But now that they've transferred, what depreciation did they charge on it? Then we use that one to determine the unrealized profit on this. Okay, so calculate the adjustment as at 31st December. Once again, look at the date. Okay, it was when? 1st January. Okay, 1st January 2016. And then we are asked to prepare at 31st December 2017. That's 2 years, right? That's 2 years. So we have 1st January 2016 to 31st December 2016 is 1 year. And the same way 1st January 2017 to 31st December 2017 is also 1 year. Okay, so that's 2 years. So in terms of depreciation, useful life, remaining life, 5 years, it will be 2 years out of the 5 years times if there was no transfer. If there was transfer, and then we'll look at the difference. Okay, all right. So the POP is easiest to calculate. We just compare the carrying amount to the amount that they've transferred. Without transfer, what would have happened? Okay, then we'll look at the cumulative depreciation in each case. Okay, the value without a transfer is actually the value we need to reflect in our statement of consolidated financial statement. Okay, because at the end of the day, we want to see the reality. Don't add a fake. It's a family thing. It's a group thing. You just add in some profit. So we want to get rid of all those stuff, and then we report the real thing. Okay, let's move on. So with transfer, they sold it at 70,000. Without transfer, it should have been 50. This is what we need. This is what we need. So they recognize a profit of what? 20. This 20,000 must be deducted from the retained earnings, the profit of the one who sold. In this case, the parents. Okay. So in the first place, that should have been what we should have done. Okay. Now, the depreciation for the 2 years is 2/5 of this amount is 28. Of this amount is 20. Okay. And then the difference between these two gives us our 8,000. So now knock it off. Usual calculation of fixed asset, carrying amount less depreciation gives you your net book value. Okay, net book value. And the difference between the two could still give us our 12,000. Now, the POP adjustment reduces the carrying amount of the plant in the consolidated statement of financial position. So this, in reality, we would have added the PPE of the parent plus that of the subsidiary minus 12,000. That is it, the first thing. Okay. Now, the profit element is then split into two. Remember, I said this 20,000 must be totally removed from the seller. This case, the parents, group reserves or group retained earnings. The depreciation element, we must then adjust it. Okay, so that it will jive. So the depreciation has to be charged by the buyer in each individual statement of financial statement. Okay, by crediting it back. This is the excess. Okay, this is the excess. You must credit it back to the subsidiary's net asset. Okay, he's the one who bought it. He has charged excess depreciation. So add it back. Okay, add 8,000 back. Okay. All right. So note that the adjustment to the subsidiary's retained earnings will then be split. Yes, will form part of its post-acquisition reserves, and then we split it between the proportion that belongs to the parent and proportion that belongs to the non-controlling interest. We split them. I think here it was 60% for the parent, so subsidiary, the non-controlling interest would take 40%. Let's take another example. Okay, so Carl bought 60% of Susan. No, I think the other one was 70%. Okay, so parent takes 70% and then NCI takes 30%. Okay, here Carl bought 60% of Susan. And then we're told that this is the element of PPE. Okay, on 1st June, Carl transferred an item of plant to Susan, 15,000. But the carrying amount should have been 10,000. Useful life, 5. Prepare extract as at 30th November. I'll look at the date again. When did we transfer the asset in the first instance? That was 1st June, okay? If you count from June to November, that will be 6 months, right? That will be 6 months. So here, in terms of our computation of the depreciation, useful life, okay, it would have been what? 6 out of 12 months adjustment, okay? And then we work it. So note, we have to prorate it for 6 months, okay? So let's take the table again, okay? The table again. So with transfer, it was 15, but the current amount in the books was 10,000. So we've recognized excess of 5,000. Now, if we want to calculate our depreciation, it will be one fifth, 5 years. Useful life is 5 years, okay? Prorated 6 months, okay? Times the amount of this 15 gives us 1,500, okay? Very sure this is correct. Let's take um, one fifth, okay? One fifth times half, okay? Times half times half, okay? And let me just take one example of the 15,000. All right. So 1,500, it gives us 1,500. Similarly, for this one, it gives us 100. So the difference of the excess depreciation charge was 500. Okay. So same story, um, cost or current amount less depreciation gives us our net book value, right? Our net book value. In reality, if we are now going to prepare our consolidated balance sheet or consolidated statement of financial position, we add that of the parent plus that of the subsidiary, and we subtract this net figure from it. That's the first step. Easy. Okay. Now, in the books of the parent and the subsidiary, what do we do? The one who sold has increased his profit by 5,000. Go and subtract it. Here is it. Okay, go and subtract it. The one who bought the item has charged him or herself excess depreciation. Go and add it back because he has understated his profit. So you add it back 500. Okay, and the net effect of this will still be the same as this for 500. Okay, so all we are saying here is that, listen, the one who is transferring the asset has recognized a profit. That profit shouldn't have been recognized. Go back into his books and reduce his group retained earnings or his group profits or his subsidiaries profit. Reduce it. Whoever is sold, go and reduce his profit by the face value of the profit that he recognized. Okay. Now, the one who has bought the asset at a higher price has charged himself excess depreciation, which has consequently reduced his profit element. So go back and go and reinstate that excess depreciation that this guy has charged himself. Okay, that's it. Okay, and in effect, when you are preparing your non-current assets, add that of the parent to the subsidiary and subtract the net carrying amount which has been excess. Subtract it from the value of the PP. Okay. I hope this makes sense. Very easy. Okay, very easy. And remember, look at the dates carefully. Please look at the dates so that you don't miss it. Look at the dates carefully so that you don't miss anything. All right. Okay, the date that they transferred so that you can prorate. All right. So again, goods in transit. Sometimes we have shipped the items whether from the seller or from the subsidiary to the other member of the party. It hasn't gotten into the books yet. They have not received the item yet. What do we do? What do we do? Always, I will prepare this, look, standing, um, taking the position of I'll take the position of the parent because we are preparing the group account. Okay. An example, on 28th December, the trading balances between parent and subsidiary was this. We all agreed. I owe you 5,000. Yes, you owe me 5,000. On that date, the parent has sent 1,000 cash to the subsidiary, which has reduced the parent's payable. So, parent knows he owes the subsidiary 5,000, but he has sent cash of 1,000. So, to him in his books, he has done what? He has reduced the payable to 4,000, but the subsidiary has not received it. The subsidiary received it sometime 2nd January. What do you do? Okay, what do you do? Simply add back your cash. Okay, just still add back your cash. As a parent, add it back. This entry is quite easy to do. Even if you don't add it from the parent's perspective, consider it received from the subsidiary's perspective, okay? And then credit the receivables, okay? Credit the receivables. That's what has happened, okay? You credit. So, or yeah, that's it. You credit your receivables. And that should be it, okay? Now the reconciled balance, the 4,000 will then cancel out because of course the 5,000 you have already recognized this 1,000. So the excess 4,000 will cancel out and it will be shown on the face of the financial position. For the receivables, add that of the parent to the subsidiary. Subtract the 1,000 because remember this has gone out, okay? And then subtract the remaining balance. In the place of the bank and cash, that of the parent plus the subsidiary, this 1,000 which is in transit, whether it has been received by the subsidiary or whether you are adding it back to that of the parent, comes back to the same result. Okay, that's it. And in terms of the liabilities, it should be parent plus subsidiary minus the net effect of 4,000. Okay, this is the main thing we need. Okay, this is the main thing. Nobody will ask you of these uh, postings of transactions, but this is the main thing we need, which we should know. Okay, all right. Let's wrap it up again. Goods and cash in transit. On the same 28th December, the trading balance between parent and subsidiary was 5. On that date, the subsidiary sent 2,000 worth of goods to P, and it has increased the subsidiary's receivable balance to 7,000. Meanwhile, these goods were not received by the parent until 22nd. Again, from the perspective of the parent, okay, what I will do is that I will debit my inventory. I'll consider that my cash is coming in. I'll debit it. Okay, sorry, my inventory is coming in. So consider it received and debit your inventory. The corresponding credit your payables by 2,000 to sync with what the subsidiary has given you. So how do we then cancel out this 7,000? In the current assets, that of parent in inventory, the parent plus subsidiary plus the 2,000 in transit. Consider it received. Okay. And then for receivables, it will be what? That of, so you know that now the subsidiary has seen the parent to be owing him how much? 7,000. But it's an intra-group situation. Okay. Add that of the parent to the subsidiary and subtract the 7,000. In the same way in payables, the same way with payables is what? That of the parent plus the subsidiary plus the excess 2,000 which is in transit. Okay. Remember, we have it here in terms of the entry. Okay. We have it here in terms of the entry. And then you subtract the 7,000 so that this will jive with this inventory, right? And this 7,000 will jive with this. That's it. Very easy. Okay. That's it. Very easy. So finally, intra-group balances. Let's take another further example. Further example here. So just extract. Okay. P and S as at 30th June. So investment, receivables, bank, and then loan stock. Okay, and payables. They said P paid 3,500 for its investment in S. Okay. Um, at the same time, P invested 60 in loan stocks. Okay, so the parent has actually given the subsidiary a loan. See, this figure here includes. They said P invested 60% of S loan stock. So this 8%, 60% belongs to the parent. Okay, at the reporting date, P's payables include 400,000. This did not agree with the corresponding amount in the S subsidiary. The difference is cash in transit. So from the parent, he owes the subsidiary 400,000. But the subsidiary thinks, no, you owe me 500,000. The difference is because the parent has issued a check, and it has not hit the account of the subsidiary. That's the difference, okay, of 100,000, okay. Prepare extracts of the financial statements, okay, consolidated financial statements. All right, so first, let's look at the workings. The cash in transit, like I said, is 100. That's the difference. What do? We add it back to the total cash and bank balances at consolidation. Whether you're adding it to that of the parent or to that of the subsidiary, you're still adding it back to that of the group. Okay. Then the receivables. It means that the receivables will now jive 400, 400. Okay. The receivables balance. Subtract the 400 from receivables and 400 from the payables. Then it will jive of the group payables and group receivables. Subtract each. Okay. Now the cost of investment, of course, this 3,500 will be used in the goodwill calculation, right? Now the P, the loan stocks, the loan stocks. We were told if you go into the question, they said the loan stocks of the subsidiary, this 500, P gave them 60%. So 60% of this 500 is 300. What do we do? It's an intra-group balances they've done. Okay, subtract this from the total investment figure, and that's of the loan stock. So it means that this total investment you find over here, 300, 300 is within this. 300 is within this. Okay, that is so. You've included some 300 here, and it's the same thing here. So knock them off. Okay, knock them off. All right. So now let's look at the calculation. So simply our investment, this minus what we paid as cash consideration to purchase the company, okay, which goes into goodwill calculation, minus this 300 loan stock, which we give to the subsidiary, gives us 4,200. This is a reality, okay. Receivables, we add that of the parent to the subsidiary, and we subtract this 400. But remember, there was a difference of 100, which was cash in transit. But the other guy said he's not received it. Subtract it, okay? And then with the cash balance, that of the parents plus the subsidiary, add that 100, okay? You will see some guys, some books will not even record this at all. And they will not record this at all after the balances are the same. And it will still jive. But show this working to know that, to let somebody know that you better understand what you have done, okay? The loan stock, that of the parents to the subsidiary, subtract the 300 which the parent gave to the subsidiary, the real figure to be 4,200. Okay, and then we can end the final one, payables, parents, subsidiary, and subtract the 400 which we had already adjusted from the receivables so that they will jive. Okay, so that is it. That is it. So it's so easy when we are working this. So before I end, try look at this question number 5 and 6, chapter chapter 18. Yeah, chapter 18 of our core text. Okay, read some more. Read IFRS 10 once again. Attempt tutorial questions we'll post on Moodle. Okay, and then you'll be fine. Okay. So like we are saying, this is not complicated. It's just a matter of technical treatment. Okay, just understand the concept, understand the reason why we are subtracting a pop from this side, why we are adding an excess depreciation at this side, and you'll be fine. You'll be absolutely fine. Okay. All right. So I'll see you in the next session. Thank you.